And in a world where prices are going up, those hard assets of commodities or real estate, they will go up in value. As an inflation hedge, that is the case, and the correlations are there. Different with tips. Tips is a little bit of a different animal.
Well, Charlie, you made it back.
Here we are.
So you had it. You're our inaugural guest, and everyone liked you so much. You're in the hot seat again.
Well, I'm fortunate to be here. Thanks for inviting me.
Of course. And this was a fun topic for us on Dime After Dime. We are talking about inflation and market volatility. I think what's really fascinating is inflation, similar to alternatives, which we talked about a few episodes ago, is kind of a hot term nowadays. It's actually really taken on a different kind of tone. And people need to start considering that in their portfolio. So we want to kind of lay out the landscape here. And what's the difference now between someone that's looking at retirement in 10 to 20 years versus perhaps past generations,
right,
as it relates to inflation and how they need to consider that in their portfolio?
So inflation, yeah, that's an interesting concept, because when I was in school back in the 80s and taking my economic theory, and inflation was the first chapter. It's basically the thing that we need to be most worried about because it erodes your purchasing power. And so much time was spent on it. And yet in my career, and I've been at this for 35 years, it's almost been non-existent because it's been going down ever since the 80s happened. And it was never even a topic. They had to post inflation numbers. It wouldn't matter. The only thing that really mattered were talking about, the numbers, the earnings numbers, or revenue numbers of companies. Inflation didn't matter. And here we are today, talking about inflation every time we turn around,
all the time,
and it changed in COVID. I mean, that was the breaking point, and now we talk about it all the time. Folks that didn't even know what it meant, now they know what it means because they see it in egg prices or meat prices or whatever, and we're struggling to get it back down to a level that is reasonable at 2%. So I think, like, for the younger generation, they never knew what inflation was. Now it's top of mind for them. And for the older generation, they're certainly now well aware of it. And in fact, in some cases, benefited from it with prices going up, especially houses.
Sure. I mean, I think that it's a double-edged sword. To your point, like, you have portfolios being positively impacted by inflation. But then when you're in that post-retirement stage and you are experiencing inflation of prices, especially medical, you begin to be like, ugh. It's a lot harder.
Yeah. So you're right. So inflation is one of the killers, obviously, for a retiree, because you don't have the chance to build up the portfolio, and yet you're drawing down on it, and you have prices inflating. That's really, really a challenge. When you're younger and you're in the savings mode, it can be beneficial. The thing about inflation, and when you think about a portfolio, you want to have a couple things, especially if you're in a higher inflationary environment. And we're not high, but we're not back to where we were at 2%. There's things you want to add to that portfolio that can hedge against inflation sticking around or going higher.
It's like you almost asked my next question for me. How do we now look at the traditional 60-40 asset allocation? How do we think about that? Let's just say 10 to 20 years from retirement, or even a little bit longer. Is there a different allocation mix to really take into account inflation and the concerns of inflation kind of creeping up again? So, I mean, how do we allocate now?
Yeah, no, it's a good question. 60-40, 70-30, 80-20. These have been the rules of the guidelines, the tablet from Moses that came down. We've talked about those forever. The thing that's, you got to remember that's different this time is that longevity is increasing. We're getting older and older and older. So really need to think about the tools that help mitigate against inflation. And some of these things, and I don't necessarily buy the 60-40 because that's what I was told to do. I think it just depends on the individual, the longevity and the risk tolerance that they have. I mean, sure, you want to scale down the risk as you get closer to retirement because you can't afford the big drop necessarily if you get that. To me, I believe that you ought to have things like, and the percentages to be determined, but you got to have things like dividend paying stocks in there. You have to have things like some hard assets, whether or not it's gold. You got to have some real estate, whether or not you own REITs or you own a house. That either way counts. For the folks that are even closer to retirement that worry about inflation, tips, the Treasury protected securities.
Sure.
So a number of things you want to consider adding into the portfolios if we're in a higher inflationary environment.
So does that, I guess I'll ask the question direct. Are there assets or investment styles that kind of protect against inflation? Are those what you just listed, or are there others?
So it depends what age we're at, right? So
Okay.
if you're on the older stage, those are the things you want to bake into your portfolio. If you're younger and you're in those 30s and 40s and you've got 30 years until retirement, then their inflation protection is going for growth.
Okay, just trying to beat inflation.
You're just trying to beat inflation, or maybe even dramatically beat inflation to grow the portfolio to the time when you need to when you're getting closer to retirement. So it depends what segment you're in. The closer you get up there in age and closer to retirement, then you want to add some of these things in. If you're younger and you have a lot of time, you really want to just try and grow the assets.
Sure. And so I think you've already answered my next question, but why do some of these perform? Why would you want to invest in these like real estate and tips? Is it because inflation positively impacts their value? Is that really what it boils down to?
Yes, theoretically it does. That they have value in and of themselves, and in a world where prices are going up, those hard assets of, at least in the case of commodities or real estate, they will go up in value as an inflation hedge. Maybe it's because we're just trained to do that, but that is the case, and the correlations are there.
Sure.
Different with tips. Tips is a little bit of a different
Okay.
animal.
Was there ever an ETF for eggs?
Ooh, good question. There should be.
There should be. All the talk about eggs, right?
I don't know. Is there a hamburger future that you can get?
That'd be great too. So I would like you to define this term for the audience before kind of explaining it, but dollar cost averaging.
Ooh.
Yeah. And that's how do you play that into the inflation mix?
Yeah. Dollar cost averaging is like one of the, if Warren Buffett said, free lunch type of thing. That's a free lunch. And especially when you're in the accumulation stage and you're in, your 20s, your 30s, your 40s, your 50s, and you have the ability to commit capital. You go to work, you get your paycheck, and you have a 401k. So important to continue to do it rotely. You don't even think about it. It goes, never even see it. It goes into your 401k. You open up an IRA, put it in IRA. But time and time again, it has proven just such a great vehicle to put it in once a month, every 2 weeks into 401k. Just makes such phenomenal sense because you're going to be buying those dips, and we get dips all the time. You'll buy stuff at higher prices too, but over time you're going to get a very good price, especially if you get the bigger drops and you're investing during that period because it's automatic. That's a home run.
Awesome. I love that. And so I guess that's a nice segue into the next question, which relates to, market volatility, especially, again, putting on the inflation glasses, if you will. Like, how do you work with your investors and your clients to kind of assuage their concerns about inflation and that market volatility in general?
That's a good question. I mean, I think that I do a lot of hand holding. And again, inflation wasn't one of those things I had to really talk about much in the past, and now we do. I think that sometimes talking about history and talking about some of the battle scars maybe that I've developed over the years when things happen, when stuff happens, and whether or not it's a tech bubble or it's a great recession in 08, 09, or the Grexit and Brexit stuff in the teens. Well, now we're in a period of inflation, and knee jerk is, oh my gosh, we gotta do something. I'm scared. You got to hold their hands and you got to explain, we go through this. There's times when this happens. Let's just make sure that we've got it out. You're allocated correctly to deal with it. But it's very easy for people to get into panic mode whenever anything happens. And now inflation is one of them. I wouldn't say panic mode, but it is obviously something that's top of mind. It's top of mind for the Federal Reserve right now.
Sure. So, that's awesome. And when you think about constructing the portfolio, are there particular investment vehicles or just investments in general that kind of have both the long-term and the growth play? Are we going back to the real estate again? Are we going back to that? Or is there something else when you think long-term plus growth.
Yeah. So the answer is yes, there's vehicles that are out there. There are things in the retirement space called target dated funds that would do just that. It would be much heavier on growth when you're young, much more balanced, if you will, with bonds and other assets that are safer or more income producing as you get older. So yes, you can get those kind of vehicles. That's why you also consider having some kind of fixed income allocation in the portfolio as well. And importantly, now it's available to a lot of folks that wasn't available. You have these other things like private equity and private credit. That is another diversifier. It doesn't yin and yang so much with the craziness of the market that's reacting on inflationary numbers that are reported monthly. So that's another kind of vehicle that you may want to think about.
Sure. I love that too, because I mean, the target date funds, TDFs, like at least back to the question about market volatility, you can say, that's a good way to say, hey, let's hold the line here. Like you said, hold their hand and kind of caution them and say, it's okay. Look at this TDF. This is in the plan. This meets your risk score. This meets your kind of your time horizon. But when I think about like, I suppose even a modern investor, someone do it themselves, with inflation on the mind, they can look to TDFs. They can look those target date funds and then try and diversify a bit maybe on those original assets you mentioned, real estate, tips, et cetera, to help them protect themselves.
Right. Yeah, no, I think it's look, I think it's really important, and I think that the target date funds, which you can create on your own. I mean, you don't need to necessarily have an ETF to do it. You can say, I want to commit this much to equity. I want to commit this much to some sort of a fixed income vehicle and commit this much to other, whether it's alternatives, it's commodities, whatever the case may be. And you just stick to it. And the emotional part is the hardest part of investing. When I was working for institutions most of my life, for institutional money, they're pretty callous. They don't really have emotions. I work for a big pension plan, and it doesn't know or care about what's going on in the market. In fact, it's usually when things are down, they're saying, let's commit more money to it. When things are up, they're like, we ought to take some off the table. It's hard for some of the managers that we hired to understand that, saying, look, we're taking money off the table. And they're like, well, we crushed it. What do you mean? Why are you taking money? Well,
Sure.
because it's time to do it. And then, the managers who've, been underperforming or haven't done as well, but we have good belief in, we give them a pile of money. It's different on the personal side because they're emotional. And when
Sure.
things are high, they want to buy more. And when things are low, they're crawled up in the fetal position.
That's, again, that whole emotional just understanding and awareness and be able to kind of, well, that's what the benefit of working with an advisor really is, to be there alongside of you. I saved my most loaded question for the end as it relates to inflation. Internationally, when you think about diversifying your portfolio, now obviously it's a bit harder, I think, as a do-it-yourselfer, right, to get into international markets. But is there a play to diversify your portfolio as it relates to inflation globally, right? Can we look at other countries or other sectors in other countries that can kind of play off of negative or positive inflation in the United States, for instance?
Yep. No, that's a good question. I mean, international, yes. There's a couple things that does for you. Every country is different, so they may not all have the same inflation rates. They have currency that can help you or can hurt you. It just spreads you around. It's not just your country's inflation rate that you're talking about. The second thing is internationally, if you look at a breakdown of like the international, like the ACWI or MSCI, developed international, what you would find is much, much heavier exposure to things like consumer staples, utilities, industrials relative to the U.S. markets where we are so tech and communication services heavy. So by nature of the staples, utilities, that kind of stuff, those by themselves are more inflationary protection. You're going to have to buy diapers no matter what. You're going to have to buy medicine no matter what. So those inherently are more inflation resistant than maybe some other things because, if they need to charge a little bit more for a diaper, you're still going to consume the same number of diapers.
Yeah, fair enough. I like that. One more, almost like a piece of advice before we go into the closing segment. One more piece of advice, though, for investors, those that are trying to do it themselves or again, 10 to 20 years out, like how would you help them navigate, volatility and inflation in this market? Like what advice would you give them?
Yeah, it goes to the stick to your guns. This is not something that you want to be. When you're investing, you try and keep as much emotion out, just like we talked about. When you have inflation that is around, you want to be sure that you're just disciplined. I guess that's the right word, discipline, that you're constantly contributing, almost close your eyes. It's not to be callous about it, but you just close your eyes and just keep doing it. You got a lot of years to go before you're going to be drawing on this money. So be disciplined. Make sure that you have enough growth. Don't let inflation scare you. Have enough growth assets because you got the time to let it grow and have its ups and downs, and contribute on a regular basis.
I like that a lot. I think the discipline thing ties back to the dollar cost averaging. Because if you would apply that kind of mindset, right, that will create a discipline, which should in turn kind of calm you down, the nerves down of inflation or volatility. Awesome. In true dime after dime fashion, we had you last time give yourself a piece of advice in what we call the Back to the Future segment. But you had such a great piece of advice. I'm not going to ask you to do that again. Instead, I really want to know what makes Charlie, what led Charlie to this profession? Like, wow. I mean, right? So I know, I'm putting you on the spot here, but the reality is financial advisors, it's a noble profession, right? And it really impacts the lives of these people that you serve.
Right.
And so is there a money moment, or is there just a decision point in your life looking back that said, this is what I want to be when I grow up, even if it was a couple years ago? Like, what was it? What made Charlie become an advisor?
Well, having just turned 60, I have a lot of history and wisdom here. So I was an accountant, and I spent my first 5 years out of undergrad thinking I wanted to be that partner at the big accounting firm. Well, I got 5 years of it under me. Realized I love the accounting, but I hate auditing. So that was I got to go back to school and figure it out, and went to business school. And it was there. I'm like, you know what? The accounting is actually really valuable, and I like the market. Let's look at how we analyze stocks. And that got me into the whole CFA process and working for institutions almost my entire career on the institutional side. This is different. And I made a switch almost 5 years ago and joined Moran. Said I got at least one good one left in me yet. And I want to use all this kind of market knowledge and wisdom and mistakes I've made and everything else to try and help individuals. But it was a little challenging trying to make that leap from an institutional side, portfolio manager, to jump into the private wealth side.
Sure.
Tom gave me the keys to give it a shot. It's been fantastic. The aha moment that I knew that I'm doing the right thing is when we had moments like in 2022 when the market was totally falling apart. And having been through a bunch of those in the past, I was seemingly the go-to guy to talk them off the ledge. And I would always get those kind of emergency phone calls because I can try and calm them down and give them some perspective and wisdom and history of what I've seen in the past and why it always pays to just stick with it.
I love it. What a great, I mean, that's a good feeling though, right? Like truly the definition of an advisor, helping people make their way.
Well, I've had tears.
Financially.
I've had tears. I've had hugs. All that kind of stuff. And I'm like, I'm not really trained for this. I'm kind of a institutional guy. I'm a CPA and CFA. Why are you're hugging me? But no, I go home and I feel really good about that.
Wow, what an episode. It was a tough topic, talking about inflation, but no better guest than Charlie to join us on Dime After Dime. Thank you so much for coming. If you like what Charlie has to say, follow him on LinkedIn. Obviously, you can find him on our website. If you liked what you heard here, make sure you like the episode and maybe even provide a comment. Don't forget to subscribe and share with your family and friends. I am Tony, your host of Dime After Dime. Again, thank you so much, Charlie.
You bet. Absolutely.